This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Ken?
Cody?
How are you?
Well, it's hard to believe another 3 months has flown by.
Just like that. It's quick.
And it gets more interesting
That's for sure.
by the day.
Yeah, definitely.
Yeah.
Definitely. Well, appreciate everybody taking the time to view this podcast. A little bit different style today because we do have a luncheon tomorrow. So for the clients that aren't able to make it, what we decided to do is essentially go through the exact same presentation and exact same slides that we are going through tomorrow at our luncheon. So that way we're not going to be recording the live event. We think that this format's a lot easier for you to digest than having to watch the live recording. So without further ado, I'm going to pass it over to Ken. He's going to go through an economic update, touch on the U.S. economy, the Canadian economy, some geopolitics, some crazy things that are transpiring.
Yeah.
And then he's going to turn it over to me. I'm going to try and make my segment brief, but I just wanted to make sure that give you a quick market update, specifically where we lie in terms of valuations, because that's the key factor I think at play today in figuring out where we are and what could transpire over the next 3 to 6 months, because in our view, that's probably the most important time period.
Without a doubt.
And then quickly going to touch on the mandates. I'm going to touch on 3 specifically, a little bit in depth about the performance, a little bit of issues specifically on the U.S. side, why we're underperforming in the U.S. Large cap strategy, U.S. focused growth managed by Poland. And then the last thing, as always, why we call it Beyond the Noise is how do we step out from all the craziness that's going on in the world, all this noise, to really drive through to what's important and what's really guiding our investment decisions today.
Yeah,
that's
cutting through the overwhelming sense of optimism on Wall Street.
Exactly.
Yeah.
So I'll turn it over to you, Ken, to start us off.
Okay. Well, thank you for joining us. We'll also, I'd imagine, make sure that we send you electronically all the slides so that you can view those. So that will be helpful. I mean, there are lots of slides to go through. We'll try to get through them as quickly as we can. But again, I think it's important to say that forecasting is not an exact science. And if it were, Cody and I probably wouldn't be sitting in this room today.
Definitely not.
And we most definitely didn't walk on water to get here. But I think, Cody, collectively we've done a very good job over the last few years in terms of our market call and making sure that we are protecting our clients' assets on the downside and delivering superior risk-adjusted returns. So I thought maybe we could just start this by having a quick little dialogue about some of the important things that we've done since 2021. And because you're the lead portfolio manager, Cody and I talk too many times a day. My forte is the big macro picture. Cody and I discussed that, and then he implements the trades according to what our collective philosophy is. So obviously, Cody, as you'll recall, as we went through 2021, towards the end, we thought valuations were extremely stretched. And maybe you could just comment on what you did.
Yeah,
from
so
there.
this was before we made the discretionary move, but Ken and I, we actually did phone every single client.
Yes,
we did. Just on our non-discretionary realm. I'm glad that we don't have to do that anymore.
Still love talking to you.
Yeah, exactly.
Glad we don't have to do it.
Just to make a simple trade amongst all the clients and articulate it at the same time has really made, I think, well, our lives easier, but it's hopefully going to articulate itself into the performance because we're able to act at the drop of a hat. But stepping back into 2021, if everybody remembers that point in time, there was a massive sense of euphoria in the market ever since COVID. Free money boosted all asset classes into what we would say was bubble territory.
Stratosphere.
And so we took that point in time to call every single one of you and essentially raise levels of fixed income to reduce our Canadian equity at that juncture. And also just our equity in totality. So that in hindsight was a good call. Did it work out entirely in our favor? Yes and no. We just had a little bit of stress on the U.S. side, which was kind of not anticipated. We had some weakness in the U.S. focused growth strategy and the international strategy, which we thought our fundamental managers and third-party managers would hold up a lot better. But from a pure asset allocation perspective, we nailed it.
And I think what's important about that is we nailed it before we got into 2022. In 2022, if you had a balanced portfolio of 40% bonds, 60% equities, it dropped 18.5% in 2022. The worst performance in over 100 years. And for almost all of our portfolios, we did a substantially better job.
We did, yeah. So we saved anywhere from probably 4 to 5% on the downside there, capturing basically probably 60% of the downside, which is a very big savings, because saving on the downside is one of the most important things for us. It allows us to get back to compounding faster, which is the main goal for most investors. What was also good is just from a pure discipline standpoint, we didn't buy the bottom of 2022, but what we did as part of our strategy was we rebalanced the portfolios in the beginning of 2023. And what that essentially means is, with equities being hit substantially, even fixed income being hit, is the rebalancing enabled us to get back to our regular long-term weights, which meant selling bonds to buy more equities.
Yeah.
And at that point in time, there was still massive pessimism in the market. That optimism flipped on its head. But it was the right call overall to rebalance, get back to our long-term weights.
And you're talking January
2023. Yeah. So with our annual rebalancing schedule, we make that call to just get back to our long-term weights on an annual basis. And that proved, if we look at 2023, even though it was a very volatile period of time, it proved to be correct. Well, in the essence that you saw U.S. focused growth
up 40%. International was up over 30%. Small cap was up over 20%. I vividly remember, and for those of you that came to the Tom Dean seminar in April of 2023, you know how I like to knock on the table and say opportunity knocking. Well, the timing there was just about picture perfect.
Yeah. And so 2023 was bumpy. If you guys remember, the Fed was getting even more hawkish, saying that interest rates could be further on the rise from already their peak policy rates. So the last luncheon we had was actually October 2023. Yeah. And that was the market rut of 2023. If you remember, we had the S&P drop 10% intra-year. We had the S&P TSX
when
drop.
Everybody was about to give up. Then came November and December.
Exactly. And so took the ride upwards. So we were fully just at our long-term weights there. I said at the luncheon that we didn't really have a viewpoint of getting more defensive or aggressive at that point. We just stuck to our asset allocation. And that proved to be also a very prudent call, because we finished off the year extremely positive.
Very positive.
Now, as we enter 2024, the story is a bit different.
Yeah.
Right? With the large performance of U.S. focused growth being up 40% in 2023, international being up 30%, small cap being up 20%, we decided at that point in time that it was reasonable in our rebalancing process to start trimming the weights specifically in U.S. focused growth and international, since they did so well. And that's what we did in February of this year for every single client. Also with the opinion that things were also getting stretched, and we're going to talk about that in terms of investor sentiment and being overconfident. And as this year has played out, sure, could we have stayed with the U.S. overweight? Yes, but
Perhaps
there are some things we're going to be discussing today as to why we're not putting that weight back and why we remain defensive at this juncture. And one of the most recent strategic calls that we have made is basically on exactly September 13th of this year, so basically a month ago, with our high income mandate, Canadian equity side being up basically 20% year to date, or one standard deviation above its mean rate of return, which is 10% annualized since its inception in 2009. We decided to trim the exposure there, take some profits, because as the Ken slides will go through, the Canadian market and the Canadian economy is not looking too good. So long story short is we've made some very good asset allocation calls over the last 3 years. Has it articulated fully into fantastic results? No, not necessarily, but it's been still very good results.
Yeah.
Okay. So the moral of the story, I think, here today is we're going to walk you through a whole bunch of stuff that's happening in the market and economy to essentially show you why we are remaining defensive today.
Yeah, exactly. And and let's not forget, you're paying us to be proactive rather than reactive. And I think we are doing a very good job of being proactive. If you notice, Cody's has a black suit on today. I have a black shirt on. It may be a sign that I'm a little pessimistic about the markets and the over hype that I see on a day-to-day basis and that Cody and I share. So I'm going to walk you through quite a few slides, and I think it tells a story that you may buy into on why at this juncture we're being extremely cautious and we have taken risk off the table. Any way you slice it, and you look at the overall world economy, it is starting to deteriorate. This is the surprise index. Anything above zero means that when economic data comes out and that data is better than anticipated, you're going to be positive. And obviously the reverse is true. If you're below zero and the results that come out have negative surprises, and you can see that that's quite a big deterioration that we're seeing in headline economic data. There's no question in our minds that the world economy is cooling. And if you take a look at the Purchasing Managers Index, which is manufacturing and service sectors, measures the health of those two sectors, you can see that that's started to drop off. That's a leading indicator, not a lagging indicator. And why do we have the red line there? Because that's earnings revision. So obviously, if the Purchasing Managers Index is coming down, we believe that that is going to have an effect on corporate earnings. But the reality is not everybody believes that story. Most people are raging optimists that believe that between share buybacks and the fact that we probably won't get into a recession is that corporate profitability is going to remain very strong and continue to grow. If you just take a look at some of the numbers that I find fascinating, if you go to 2025 and look at U.S. corporate profitability growing by 15.5%, that to me is completely unrealistic. And if the major markets in the world are headed south because of this, then how could you get earnings growth in the emerging markets of 16%? I also get a kick out of Canada. It's, jumped from 4.5% in 2024, this year, all the way to 11.3%. I just don't believe this is in the cards whatsoever. So the forecasts, I think, are completely offside. This is the...
You just went back the other way? Don't worry.
No, I didn't actually.
Okay.
It's the same slide as
same.
the first slide.
Okay, sorry.
Okay, yeah, you can't fool me.
Okay.
You know,
I
my
apologize. Sorry, it looked the same.
my brain is still operating. The
There we
body
go.
may be breaking down a little bit, but the brain, as long as it's still
we go.
working. So, the first slide, the same thing.
Yeah,
This just the first slide was the world. This is the U.S. economy, and you can see that the U.S. economy is breaking down deeper on the negative side than the overall world economy. That's just why I wanted to show that chart. But you take a look at bankruptcies, and as of recent, bankruptcies right now in the U.S. are totaling close to 500,000 bankruptcies so far this year. That is a 16.2% increase from last year. And what I think you should find interesting is that is even substantially higher than COVID. So there's no question businesses are feeling the brunt of the higher interest rate environment.
Yeah, we're still there.
And we're still there, and we're going to talk about that. You take a look at the job creation, and anytime you're above 50, it means that more industries are creating more jobs. When you're below 50, it means less industries are creating less jobs. And yes, the unemployment rate is 4.2% in the United States. But if you're looking at that chart and looking at the direction of that chart, I think that gives you kind of an idea about employment going forward. Here's part of the big problem. It's, in September, U.S., 104,000 more jobs. They created 240,000 jobs in September, but the reality is they're not full-time.
Yeah, they're part-time.
And it's more part-time, seasonal.
Gig economy.
Yeah, exactly. I think that's a critically important thing in the overall picture of the economy. This is a great slide. You have to take a look at, real GDP sitting there last quarter at 3% in the United States. But the challenge is consumer spending is going the other way, and consumer spending represents 70% of GDP in both Canada and the United States. And consumer spending is becoming a challenge, obviously, with higher interest costs. You've got mortgage debt, has been risen substantially. You've got, fueling your car. You've got food at the grocery store. And the consumer is starting to feel that. And I think they're not going to get out of that anytime soon. So I think we're going to see the consumer continue to start to fade. So when you take a look at this just goes to prove my point earlier, is you take a look at credit card debt. Credit card debt's the highest level it's been at since 2011. Automobile debt is the highest level since 2001. Well, you take a look at so far this year, consumer debt in the United States is $17.8 trillion.
Crazy.
The highest point in history. I said 17.8 trillion of consumer debt. What's even more alarming, and don't listen to me, listen to two of the best hedge fund managers in the world. You take a look at Ken Griffin and Bill Ackman. They both sounded the alarm on government debt. The total government debt today is $35.8 trillion. And for the consumer debt, hopefully I said trillion, because it's in the trillion, not the billions. It's just, trillion. It gets there. So you look at that amount of debt, And what you and I found fascinating is at 34.8 trillion of government debt, if they keep up with the same spending patterns, and that's what the two hedge fund managers are worried about, is that debt level is going to grow by $1 trillion every 100 days, which means by 2028, you're looking at a $50 trillion deficit.
Yeah.
For every eligible U.S. taxpayer in the United States, they owe basically, or they share $1 million of that government debt. What a nice thing to pass on to your children and grandchildren.
Yeah.
Crazy what's happening out there. So I thought this was really humorous because this wasn't my idea of the slide. It was Cody's idea. And he said, Dad, it's actually not a slide of NVIDIA. Well, it virtually looks identical to NVIDIA, but it's not. It is the total U.S. costs per year. And to service that $35.8 trillion of debt, it costs $1.2 trillion a year, or 23% of every taxation dollar that is collected in the United States. That cannot end pretty. But doing this for 40 years, I can't make super bold calls, but if that doesn't correct itself immediately, it's not going to end pretty. I get a load of this. It's just to take, you take a look at inflation. I mean, in the U.S. and Canada, I mean, here in the U.S., we're almost at a 4-year low. Headline, whether it's headline or core, headlines includes food and energy. Core does not include food or energy. But you take a look at that, inflation has fallen off a cliff. But on the other hand, here's the real problem, is that the Feds, Jeremy Powell is being so restrictive. And what makes you think they're going to get it right on the flip side? We've told you many times, prior to the tightening cycle, we said, quote unquote, they took the punch bowl away far too late. People blew their brains out with free money.
That's why we had 2021.
That's why we had 2021. So what makes you think they're going to get it right to ease monetary policy? And as we know, and the slides indicate, they're already behind the curve. Mm-hmm. So there's no question. I find this chart very, very interesting, because will interest rate cuts save the day? Well, the Feds should have cut in late July. They didn't. So they supersize us on September 18th by half a cut. Half a percentage point, 50 basis points. There's 100 basis points in 1%. So 50 basis points cut. And that's only happened twice before in history. 2021, 2007. 2007, the S&P, the next year, dropped 54%. Unemployment rose, landed in a recession. 2021, 448 days later, S&P's down 40%. Unemployment rose to 2.1, another 2.1%, and we're in a recession. It's dangerous to say that this time may be different, but I believe that's a compelling chart that tells the story. Soft landings are rare. If we go back in the last 70 years, I'm going to pause. How many soft landings do you think the Fed has been able to achieve in the last 70 years? I know you're at home. Think about it. The reality is 2, But if you take a look at it, the last time the soft landing, if you look just before 1990 and in between 2000, you can sit there and see, yes, 94 and 95 was a soft landing. But every time you see the Fed cuts, look when the Feds cut. When the blue line goes down, then look at the brownish line that goes up. That the recessions are the faded line. In almost every time the Feds cut, we end up in a recession. Are you hearing that on the news? Are you reading that in the papers? No. But this is what we're reading. This is why we're different. This is why we're proactive rather than reactive, and we're trying to convey a message that this is what we are concerned about, and we are managing your money accordingly to what we see in these charts. Let's talk about Canada, but let's not dwell on the fact because Trudeau's had enough today. He's obviously in complete denial. He was asked yesterday in French whether he thought he had a leadership issue, and of course he said no. It's very different than what his party thinks. But, you always see those signs, the little red thing, in case of emergency, break the glass, fire, break the glass. Yeah. Well, it's time to break the glass on Canada. These slides I find embarrassing as a Canadian. We just take a look. Again, Tiff Macklem is no different than Jeremy Powell. They are both we think, have messed up considerably. Mm-hmm. Look at where Canadian inflation is right now.
Yeah, we've been talking about it for so long.
Yeah. And there's two countries in the world, Sweden and Canada, are the only countries that include their mortgage
interest costs,
and
which
interest
are dictated by the central bank.
Right.
Yeah.
And so really, the rates in Canada would be lower than that.
Yeah.
So what is going on with good old Tiff? Okay, big deal, Tiff. I thought you were going to supersize us today and give us like 75 basis points, but, obviously, we got 50 basis points, and we'll get another 50 basis points in December. But I thought there might have been a surprise because you're so far behind the curve that you might have been like driving through McDonald's and going for the supersize. But at least we got 50 basis point cuts. But I can reassure you that both the Feds and the Bank of Canada are substantially behind the curve, and that's a problem. This is an embarrassing slide. If you take a look at the gross domestic product of the United States and of Canada, most recently the GDP of the United States is 3%, and we're barely at 1%. And you just look at that, that is below levels that we haven't seen till 2016, and that's an embarrassment, and that is why money, capital, investments are leaving this country. And it's all about productivity. Look at the difference in productivity. It's no wonder. Mm-hmm. We have a government that is messed up considerably in so many different ways. We have high levels, some of the highest levels of taxation in the world. We are not spending any money on infrastructure. All the money is going out. I think last podcast you said the amount of capital leaving Canada was astronomical. Mm-hmm. So that's a problem. And that productivity drought isn't going to turn on a dime. This is years in the making. This is good old wonderful Justin Trudeau. That former school teacher that, he'd do the social media and he'd do the selfie with you. Yeah. Well, you can thank Justin for this. I know I'm not allowed to talk about politics, but
it's the truth.
Yeah,
it's the truth.
Yeah, I mean, just go back 10 years ago. Like he was taking selfie with everybody, and all the young people loved him. Now they hate him, right? He's on his way out.
Sunny ways, my friend.
Yeah, sunny ways, my friend. Yeah, it's like make America great again. And as Cody alluded to last podcast, this is part of the big problem. I mean, out of top 20 countries in the world, Canada ranks 5th in terms of immigration and probably growing up the ladder. And how do you let 1.2 million people in the country each year for the last 2 years and expect us to be productive? I mean, it is, it's a real challenge. You take a look at why we have a housing crisis, and a health crisis. The average wait room in an emergency hospital across Canada is 22 hours. 22 hours.
It's crazy.
I'm having problems with my left knee. I wanted to go see an orthopedic surgeon. Apparently, it now takes 1.5 years just to get a consultation. So the drain on the housing market and the health market, I think every Canadian has felt that. You look at the number of the deficit. For every 4.8 people that are of working age in Canada, we're building one house. One house for 4.8 people that are actually working. That has fallen off a cliff. This is what I think is the most ridiculous slide. I guarantee you Trudeau doesn't understand this slide, has never seen it. Freeland hasn't seen this slide. But if we're building approximately 250,000 homes a year, how is it possible that we're going to double that for the next 7 years and build 550,000 homes a year? I mean, Cody,
it's impossible.
You're a numbers guy.
Yeah, but just looking at that, it's impossible. But if you get into the real numbers of it, is you actually look at the construction capacity to build these things.
Yeah,
the capacity is already maxed out. You're also seeing employment in construction decline dramatically.
And this is exactly what you're talking about.
Oh, sorry, I didn't even know you had. I didn't even know you had that slide. But,
so you're gonna build 550,000 homes, and of course, don't you forget where part of that money's coming from. Remember that capital gain tax that you forgot about? Yeah. Well, Justin is going to raise exactly $19.8 billion in the next 5 years to pay for what he thinks is a pipe dream of building those new houses. It just clearly is not going to happen, and this is going to stay with Canada for a very long time. Okay, I got to be cautious here, right?
Calm and cautious.
Well, what can I say? I know what I'd like to say, but unfortunately, I can't say it. Anything is possible, as we know. We know it's less than 2 weeks away. The world will be watching. I think there's, issues for everybody in the world. And it's obviously going to be a very tight race. And, obviously if Trump gets in, it's people say, well, what happens if Trump gets in? What happens if Harris gets in? Well, immigration, they have different views. They have different views on abortion. They have different views on taxation. Carmelo wants 28, Trump wants 15 across the board. But the big thing for Canada is the tariffs. Mm-hmm. What most people don't know is that 80% of Canada's exports in terms of goods and services go to the United States. Yeah. So if there's more tariffs on Mexico and Canada, and we just talked about how bleak Canada is, mm-hmm. that could be a major, major setback for Canada. What can we tell you for sure? We've already seen it. The market's been down 3 days in a row. And as we lead into this election, we know that volatility is going to continue for sure. And if we take a look at the Shiller PE ratio, price over earnings, you take a look at where we are today at 37 times. That other peak is just in 2021 of October, right in the same level at 38. So call those two dates the same. So we are one more time at the going back all the way to 1975. We're at the highest Shiller PE ratio
Since the tech bubble.
Why are we being cautious, Cody?
That right there, and we'll get into the valuations in a sec.
Yeah. This is another huge challenge, which today I think the announcement was mind-boggling, and we all know these points. I think the cyber attacks on us personally, I mean, they're growing every single day. But what was announced today, if you missed it, is North Korea, Kim Jong-un, has now sent his troops to Russia. And if that doesn't intensify the situation between Russia and Ukraine, and also what's happening in the Middle East, the markets don't like uncertainty. And this is a high level of uncertainty.
Definitely.
Okay, well,
Awesome.
That's enough for me. Your turn.
Thank you.
You're welcome.
Alrighty, so that was Ken did a great economic update touching on Canada, US. Now it's time to really dive into the actual markets themselves, specifically touching on equity markets. Going to focus on Canada and the US specifically. International, just for the sake of time, we're going to let slip by the wayside. But then also just going to touch on fixed income because of the discussions surrounding rates, and we're heading into an easing cycle. Fixed income should be on the top of everybody's mind to say, okay, well, where are we headed from here?
Especially in Canada,
right? So quickly up on the slide here, we have all the rates of returns for the major indices. Overall kind of story is it's been a good year. Yeah. Lots of euphoria driving the markets. Basically, it's not even a soft landing scenario anymore. It's a no landing scenario.
Yeah.
So we see S&P TSX up 14%, the S&P 500 up 20%, over 20% now. Dow Jones has done well. The NASDAQ has propelled quite well. A little bit weaker in terms of the Russell, which is small to middle capitalization companies in the United States, mainly lagging behind their larger counterparts, which we've already spoken about in previous podcasts. Kind of an opportunity knocking there from a valuation standpoint. International markets also up, not as great as the Canadian or US markets, but still positive 10% year to date. And the bond market, lastly, the FTSE Canadian Bond Universe has also done extremely, extremely well, up 4.27% year to date. So very strong performance across all asset classes.
The big surprise in the third quarter on the TSX.
Yeah, the TSX,
market.
9.71%.
Go figure.
I know, crazy. But that's what we've been alluding to for quite some time, and why we kept our weight to Canadian equity. If you recall, when we gave our fourth quarter 2023 podcast, we talked about specifically what were our changes. And we alluded to the fact that we were going to trim US focused growth and international, which we did in February. But we also built you a very good case as to why we wanted to keep our Canadian equity exposure. And it was kind of twofold. There was extreme valuation differences between the Canadian market and the US, mainly due to, I think, a lot of the concerns Ken already talked about in terms of the Canadian market kind of already being priced in, but also the fact that these are very strong dividend payers that have consistency in terms of paying out their dividends, but also growing them. And that's being rewarded here as we see interest rates drop.
Yeah, finally the banks have, started to gain some traction and had some money to the table.
So just we're going to dive into the U.S. Equity market first here. When I'm talking U.S. equity, I am referencing the S&P 500, the main market here. So this just goes to show, I'm not going to go into detail, leading contributors, leading detractors for the year thus far. and also how specific industries have performed for the year thus far. So it's been actually quite a broad-based rally, but the one thing that I just wanted to point out here, which we've talked about at other podcasts, is you take a look at the top contributor to the S&P 500. NVIDIA has been up 145% this year alone, and a single stock has contributed out of that 20.81% for the S&P 500 year-to-date return. It's accounted for 4.45% of it. One stock.
Mind-boggling.
So when we get to U.S. focused growth and why we've underperformed a little bit,
go back to this chart.
That's a key thing to remember, because we do not hold NVIDIA in our U.S. focused growth mandate at this point.
It trades at 23 times sales.
Yeah.
And if you go back historically at the S&P 500, most companies trade between 1.4 and 2.6 times sales. Anything over 3 times is deemed high risk, and this stock trades at 23 times sales.
And the problem,
unconscionable.
The problem with it is, if we're just looking from a relative valuation standpoint, yes, off the charts in terms of those things. But when we talk to the portfolio manager, Dan, who is the lead PM of U.S. focused growth, his rationale for owning NVIDIA comes down to it doesn't have a recurring revenue model. And when he operates a mandate, the whole thing that Dan and Poland is looking for is consistency in terms of generating double digits earning growth, in the fact that earnings growth will articulate itself into share appreciation. He does not believe that NVIDIA has a recurring business model at this point in time in terms of its revenue generation.
What happens when Microsoft, Meta, Apple, and everybody stops buying their chips?
And yeah, exactly.
Where's
and
their
a lot of
next
it's
revenue source
hardware orientated. And when it's hardware orientated, where unless they're changing their revenue model in some shape or form, it's just, from our perspective, the manager we are talking to, Poland, a lot of this is overhyped, and I think you just got to be careful with this name at this juncture, because the contagion, if a lot of this revenue doesn't come to fruition and the high expectations that have been set for their revenue growth moving forward, if that doesn't come to fruition, that thing might drop like a tank, and hopefully it doesn't carry the rest of the market with it.
That's a concern.
It's a concern, because we've seen it play over multiple times again in terms of lots of names on the Toronto Stock Exchange. Remember Valiant.
Don't think Nortel.
But it's just history. History doesn't always repeat itself, but it tends to rhyme, right? It could change the world, but hype is usually overdone in the short term. And we don't even know the long-term effects of what generative AI is going to have on our economy. How is it going to impact it? It's all speculation at this point, right?
Yeah,
and we're not here to be speculators.
No.
We're here to make strategic placements in well-founded businesses that have a proven track record from a management standpoint of expanding earning multiples. So that's the U.S. equity. And so a lot of this side of my presentation is going to be revolved around valuations, and why we're remaining defensive is basically due to high levels of valuations. So we take a look at U.S. equity, and we look at the trailing price to earnings multiple and the forward price to earnings multiple. And just quick education segment for people that don't understand price to earnings. It is essentially the share price divided by the earnings. And people will say, well, what does that tell you? It basically tells you how many times are you paying for $1 of a company's earnings. So if there is a price to earnings multiple of 5, that means you're paying 5 times what it would take to generate $1 of earnings. That's not bad.
It's good.
Okay? The lower the price to earnings multiple, the better, because you're paying less for $1 of earnings. The higher the price to earnings multiple, the worse it becomes, because they have to generate a lot of earnings, and you're paying a lot more in today's dollars to obviously acquire that security. So what we look at from a valuation standpoint, and I'm mainly going to focus on we can focus on both trailing and forward, but we look at the trailing price to earnings, which is based on essentially the previous 12 months earnings, basically over its share price. And what we can see is on the 10-year average, the S&P 500 has traded at 21.3 times. That has been historical trailing PE average. We are currently at 26.3. You can kind of see the peak in 2021 where it got up there. We're not exactly there, but from an forward standpoint, where we're taking into account forward earnings and analyst estimates, we're basically there. 21.8 times forward earnings when the historical average is 18. Long story short, the U.S. market at this point seems to be significantly overvalued. And that is a concern for us, and hence why we still remain underweight in terms of our U.S. focused growth strategy, specifically speaking.
Putting it another way, we think the U.S. market is priced to perfection.
Over perfection.
Okay.
Yeah.
Over.
But what's interesting to note too is when we look at these valuations, and we also look at where we are in terms of the economic cycle, it's interesting to see, okay, well, we're stepping into an easing campaign. Interest rates are coming off. But if we look back historically speaking, when the Federal Reserve was lowering rates, where were we from a valuation standpoint at that juncture? Were we priced expensive with high price earnings multiples, or were we priced reasonably low? And so this chart goes to show you, basically dating back to 1980s, the specific points, the yellow dots are the start of these easing campaigns. Okay. The last one happened in COVID. We obviously saw the recession. That was an emergency cut.
I was managing money way back here, and you weren't even born yet.
I wasn't even born.
Yeah.
No. But you take a look at the chart, and there's only been one point specifically in time where valuations beginning an easing campaign have been higher, which is not a good thing. And that is the tech bubble. And that's holistically on the market itself. But if we take this even further and look at the sectors themselves compared to the easing cycles in 1995, 1998, 2001, 2007, 2019, we look at the sectors and where their price to earnings were at a specific point in time, you can see that on average today, which is the bottom portion of this graph, every sector from a price to earnings perspective is higher or even closer to the higher end than any other point.
I think this is a compelling story right there.
Than ever beginning an easing cycle. So we're heading into this easing cycle at very high valuations just from a market in general, but also it's concentrated amongst basically all sectors except for one, which is energy.
Yeah.
A little bit concerning.
And real estate.
This also goes to show you, again, where the specific things were before the Fed's first interest rate cut. Forward priced earnings, we've already been through that. The earnings per share growth is also important. We're on the higher end, which means a lot of the sentiment out there is earnings per share growth is going to be super high, almost to the extreme at any point in the previous easing cycles.
And, you know, I like to say, the consensus view is usually wrong.
If we look at the VIX too, and MOVE, which is essentially the bond volatility, VIX is equity volatility. On a volatility standpoint, from where we sit, volatility has actually been lower, but we have stretched valuations. So, and corporate spreads, which is the craziest thing. I'm not going to get into it. But spreads between absolutely junk debt obligations or junk bonds versus high credit worthiness companies is at the probably one of the lowest margins it's ever been on record. Yeah. So long story short, it's a tough landscape for U.S. equity, I would say, moving forward into the easing cycle. And that's why we want to remain defensive. Canadian equity, now flipping over to this. Not going to go through it. This is just more a slide for people to view. Leading contributors, leading detractors, attribution detail, sectors across the board. Energy and financials have done extremely well, hence why the TSX has done well. A couple lagging sectors: consumer services, consumer cyclical, doing poorly. Obviously, you take a look at Rogers being in one of the leading detractors. Same with BCE, right? It's been a tough year for...
Well, it's been a tough 3 to 4 years for them.
Definitely. When we take a look at Canadian equity from a valuation standpoint, compared to the United States, is we are actually in line in terms of the 10-year averages, okay? Which means the Canadian market is fairly valued at this point in time. So you may be asking, well, why did you cut your exposure to high income, which is Canadian equity, literally last month? Well, if Ken's slides weren't enough to tell you about the devastation that's happening,
and we were up 20% so far.
And we were up 20%, which is one standard deviation above our historical mean and average rate of return of that portfolio. It was time to take some profits.
Absolutely.
It was time to cut back to where we saw a nice run up. And if there are a lot of the things we're discussing, if they do end up getting worse or come to fruition, there is going to be, unfortunately, significant earnings revisions downwards. And that's going to have pressure on all types of Canadian stocks. But again, this just goes in line with the previous. From a total market perspective, TSX is fairly valued. And we take a look at the industries themselves, they're also relatively in line, except for the main culprit, which is energy. Okay. So the biggest thing is, with all these concerns, I've already said it, is if these risks come to fruition, earnings are going to have to be revised downwards.
That's going to affect
going to affect corporate profitability. That's going to affect share prices significantly. And hence why we took some profits while it was good, and we're just remaining defensive on the Canadian equity weight for now. The next space, getting away from equity markets into fixed income or bonds, it's just all about interest rate cuts at this point in time, right? So what we've listed is essentially what is the target rate in the United States. At this point in time, it's 5%. In Canada, it was 4.25, but now it's 3.75. So what we can see is National Bank has a great economics team. These are what their targets are moving forward over the coming quarters. And what you can see is there is a bit of a discrepancy between Canada and the United States. As we see already, they are predicting Q4. By the end of Q4, Canada's target rate, which is now, as of today, 3.75, they're expecting, as Ken already said, another 50 basis points of cuts.
So it's going to hit 3.25.
It's going to hit 3.25. But what's even interesting is if we look further, a lot of that economic pain that's happening in Canada, we think is going to drive more interest rate cuts, to where by the end of the third quarter in 2025, National Bank thinks that the Bank of Canada target rate is going to be 2%. Dramatic drop from where we were. And you know what? Wouldn't be surprised if stuff really gets ugly.
Goes lower.
That it goes lower. The US, on the other hand, a little bit more tamed, right? We have the target rate at 5%. We don't know what's coming out next meeting from the Federal Reserve. But there is, I would say, a more shallow drawdown in terms of the target rate. And that's because the US economy, although there are signs that it's deteriorating, is still holding up a lot better than Canada, right? And so what we see is a little bit of a discrepancy between the rates, but overall, you can see the larger drop on the Canadian side, which means if there's larger interest rate drops and there's an inverse relationship between interest rates and bond prices, the best place to be from our perspective is Canadian fixed income, okay? Benefiting from the drop in rates, and that's why we remain, even though it's a go anywhere strategy in terms of fixed income, both we can invest in US Treasuries, Canadian Treasuries, we still remain confident in investing in Canadian bonds at this juncture.
Yeah, because you've seen the last couple of days US bond yields rise.
Yeah, exactly. And that's also another concern with the bond market, even though we believe inflation has been eradicated, some geopolitical tensions could promote some sort of rebirth of inflation, right?
For sure.
And if that happens, then bond prices would inevitably creep up? Could we see a little bit of capital deterioration in terms of fixed income? Yeah, but they ain't going back to where they were.
No.
Okay. So the big thing is when I'm mentioning the difference between policy rates between the Central Bank of Canada and the Federal Reserve, whenever there's a differential, it has an impact on our currency, right? So people always say, well, you know what? The Bank of Canada can't stray too far from the Federal Reserve because we'll end up destroying the loonie. People tend to forget, if we actually look back in time, there has actually been short-term variations in terms of our target rate and discrepancy with the United States. And it hasn't really crushed the loonie in any shape or form. And that's what we're kind of anticipating here. There's going to be a short-term divergence between Canada and the United States in terms of their policy rates because we are at different points in our economic cycle. We're already deteriorated and deteriorating faster than the U.S. The U.S. is behind us. They're not deteriorating as fast. And that promotes more forward cuts in Canada, lagging with the United States. Yeah. But at some point, it's going to even itself out. And although we think the U.S. dollar is going to appreciate, and my call, to be honest with you, is the U.S. dollar getting to 1.42 probably by the end of the first quarter of 2025. I don't think it's going to crush the loonie in its entirety. But if it does, the one thing that we have as a saving grace is we do have a lot of U.S. dollars.
We have a lot of U.S. dollars, and if the tension in the Middle East continues and around the globe, oil is going to remain strong, and
exactly
that'll be
good for the petrodollar, as they say.
Yeah.
And then this is again talking about I almost bring this up because this was a slide that we brought up actually at our last luncheon where we were talking about what happens in terms of investing in bonds after we go into specific cutting cycles, right? And so we can see the returns in bonds basically after a year of peak policy rates has been quite substantial across different historical points in time. And so if we take a look at actually our fixed income mandate, which I'm going to go through, over the last year, the fixed income mandate has been up 12.1%. If you take a look at some of these, coincides exactly with those numbers. So fixed income has been a very good mandate for capital preservation. It's been providing income, and it's performing exactly like it needs to. Yep. So quickly, mandate review. I'm not going to go through this in depth. These are the rates of returns for the mandates. So far, we have all the fact sheets available. Feel free to view them. We've had strong performance in fixed income, up 5.1. High income Canadian equity has been on a tear. It's up 18.9%. U.S. focused growth is lagging a little bit. We're only up 11.27 compared to the S&P 500 being up 20. Small cap is having a little bit of a tough year. Still up 3. International up 4.54. And then strategic alternatives is up 2.19. So just looking at strategic fixed income can show you the rates of return against the benchmark, beating the benchmark on a year-to-date basis for 2024. Index has only done 4.27. But the big thing, as you can see, is when we started this mandate in 2021,
the worst time to ever start
a pure bond mandate, even though we did have bonds before through our blended Verus defensive income, if we remember that. Immense capital protection when we went through the fastest hiking cycle. The index, when we started this, is still negative.
Yeah.
We're positive still. So still good performance on that front. Canadian equity, just flipping over there. We're beating the benchmark on that side, up 18.93% year to date. Benchmark is only up 15.96%. So really good performance on the Canadian equity side, but I think a good time to trim.
And the U.S. can be self-explanatory. I mean, we don't own NVIDIA, and we're not going to. So you don't own that one stock, you're already behind the market.
And that's why we're behind the market with U.S. focused growth. Had a phenomenal 40% year last year. Yeah. But then again, we got to see how the remainder plays out.
I think the way that you should be looking at it is you got 40% last year, 40.43. You got another 11.65% this year. So in
2 years.
2 years, you're
up
up
50.
You're up 50%, and we're not taking the risk to own NVIDIA.
Well said. I think that's all you need to know.
Yeah.
So that's it for the mandates. The fact sheets are there. Performance reports are coming out. You're going to see all the returns there. And if you ever want to chat about a specific mandate, Ken and I are always available. So just the last section that I just wanted to go through is going beyond the noise. Okay. We've highlighted probably a lot of noise today already. There's a plethora out in the news and all that. But I think it's important as wealth advisors is going beyond that. And there's some larger lessons at play that really cut through the noise. One of the key things that I want to mention, especially Ken already brought up, is the US presidential election. To be honest with you, and I'm going to say it, the market doesn't really care who gets in. Okay? All it cares is about the uncertainty leading up, as Ken alluded to. This graph goes to show you if you decided to invest $1,000 just purely based on whether your preferred party, whether Democratic or Republican, got in, and just purely invested with them at specific points in time during the term, what would be your associated rate of return? So if you invested with Democrats over 26 years that they've been in power since essentially 1974, you'd be up 7% annualized. If you were a Republican and you only invested with Republicans in power, you'd be up 5%. The market doesn't give a crap, and pardon my English, regardless or not, if we blend them all together, the rate of return is 12%. So it doesn't, if you're fighting, who's going to get in? Over the long run, the market doesn't really care. And you know what also the market sometimes doesn't really care, and why it's a persistent vehicle for transferring money from the inpatient to the patient, is it also can get through geopolitical risks. All of these events have transpired since 1968 all the way up until this year. USSR invades Czechoslovakia. We have the Gulf War. We had the energy crisis, 9/11. The list goes on and on. And in the moment, I understand that it's a lot to essentially take in, and you may think the world is falling, the sky is falling, but the market is persistent, and it's time in the market that matters.
Yeah.
And again, it's all about, I talked about it the last luncheon, and this was when, last luncheon was October 19th, 2023. At that point in time,
The anniversary of the stock market crash.
yeah, the anniversary of, 2023 being a good year up until July, when markets basically corrected and lost all the gains for 2023. Mm-hmm. But I remember at that point in time, we were really focused on telling you, we don't necessarily know where we lie in terms of where the market is headed at this point in time. But what we can tell you is we want to just purely focus on the things we can control. And if people were at that luncheon, you'll remember that. And what we did is, instead of making a bold, rational call to get more defensive, everything was seeming pessimistic at that point in time, we said, you need to accept that markets are going to be volatile. You're going to need to accept that political risks are going to come into the picture. That's part of investing. You also need to be persistent, because if you cash out at specific points in times and think the world is ending, we went through slides that showed you that's almost financial suicide. And the other thing is being patient. And so because we focused on the things that we could control and not the things that we can't, we held through. And ever since that point in the luncheon, the S&P TSX has gone up 20%. And that's why when you receive your quarterly performance reports and you take a look at the 1 year rate of return, basically every single one of our clients is up northwards of 15% on a 1 year basis. Persistence, patience, and acceptance are the keys. And it's kind of funny because we had one client who we thought was well versed and had a high level of financial literacy.
Oh, I know. I know what you're talking about.
Ended up losing his patience, losing his persistence, and I remember I remember selling almost, it was high up there in terms of the millions, all on November 1st of 2023. Not even an in-kind transfer out, taking your
yeah, he
securities
sold
with
everything.
you. Sold everything, and you can be rest assured, missed out on that. So I also presented this with all the noise in the background. We want to focus on the things we can't control. It's about the 3 principles of patience, acceptance, and persistence. But the main thing that we really focus on to make our shifts in the portfolio really comes down to behavior, in our opinion. And Benjamin Graham, and I presented this last luncheon, has a great quote. The stock market is a forever pendulum that swings between unsustainable optimism and undeniable pessimism. And we believe that when the pendulum swings one way or the other, it's sometimes very difficult to pinpoint where you are. But at this point in time, we believe the pendulum has reverted to the unsustainable optimism route. And when it does, that means we want to be proactive rather than reactive to defensify your portfolios. So when this pendulum swings...
I'm surprised you haven't figured out how to stop it on that unsustainable optimism.
I know.
You've got every other trick in the book. Like, I mean...
But when that reverts the other way around, we want to ensure that everyone's defensified. And
Absolutely.
That's why today we've taken care of everybody. Our portfolios are prepared for what lies ahead. And now we just wait and see what unfolds. But you can be rest assured, if that reversion happens and we swing to a place of unjustified pessimism, we'll be ready to react. Well, thank you all so much.
Thank you
for taking the time to watch this video.
Sorry you're going to miss out on the beautiful wine and the luncheon tomorrow, but
hopefully we'll see you guys all in the next one.
Next one for sure. And as usual, if you have any questions or concerns, feel free to reach out to us. That's what we're here for.
Awesome. Thank you,
Thank
guys.
you.